Market participants were alert to the outcome of the Fed's policy meeting yesterday. They were wondering whether the U.S. Central Bank would revise its rhetoric on the back of the bank turbulence and the threat of a recession in the United States economy. The answer to this question is a thorny issue that will determine medium-term trends across global financial markets. Apart from the Federal Reserve, the Swiss National Bank and the Bank of England will also hold their policy meetings, and their decisions could also serve as a market catalyst. Let's discuss this and other events which are due in the last 2 days of the week. Investors are well aware that a few banks went bankrupt in the United States and Europe, in particular Switzerland. The Swiss authorities mediated the major deal to enable UBS to take over its alien rival Credit Suisse. Previously, massive withdrawals of deposits dented trust and put the whole banking sector into jeopardy. The government's influence in the purchase deal revived trust among investors, and now the Swiss Central Bank is shifting focus back to high inflation and is likely to update its monetary policy through a rate hike by 50 basis points. This move will support demand for the Swiss franc. The Bank of England will also go ahead with its monetary tightening. There is no other option. Inflation has been accelerating without any sign of a slowdown in the consumer prices. The central bank predicted that the annual inflation rate would slip to 8% by mid-2023. Oddly enough, the CPI rebounded to 10.4% in March, thus forcing the Bank of England to take action. Before the publication of the inflation data, investors speculated on the likelihood that the regulator might hit the pause button on the rate hikes. The red-hot CPI assured the market of an imminent rate hike. Such expectations are bullish for the pound sterling. There is an island of stability amid a series of economic shocks and alarming uncertainty. It's an island country called Japan. Remarkably, Japan somehow evaded soaring inflation. Unlike the rest of the world, the annual CPI is expected to decline to 3.3% in March. And you are aware that the Bank of Japan maintains the key interest rate at -0.1% with the aim of supporting businesses. The regulator believes that inflation is accelerated entirely by external factors, and the sitting on the fence approach seems to have justified itself. Indeed, the pace of the annual inflation growth has been slowing down, heading for the official target level set at around 2% per annum. On a Friday, the market will get to know a new portion of unpleasant news from the UK in the retail sales data for February. Analysts project a minor growth of 0.2% from a month ago. Retail sales are expected to remain in a negative territory in the annual terms. Consumption activity is still sluggish in the United Kingdom. It does not inspire optimism and makes investors stoke recession fears. Market participants also voiced concern about a looming recession in the U.S. economy. Late on Friday, traders will take notice of a change in the durable goods orders, and the median forecast is likely to expose signs of a soft demand and consumption activity. Importantly, consumption is the linchpin of the U.S. economy. How we're going to be in the short term in financial markets, we will definitely tell you in our news releases. Subscribe to our channel and follow news with us. See you soon!